Okay. I guess I'll tell you a little bit about myself. So I give a little bit of backstory. Originally, I worked in IT. I did computer networking, engineering, and eventually went into management and got lucky enough to fall in with some Fortune 500 and Fortune 100 companies. And my view on finances had always been um, so when people had computer problems, I always figured if you got a computer problem, you come to me. I'm the computer guy. And so originally, that's the way I felt about finances. And so when the jobs that I had, they always had some sort of like matching program for retirement. So you put away this much money and they would match it and those sort of things. Um, but I always left it up to a financial manager and said, okay, well, these guys are the professionals. They know what to do with money. So I'll give it to them. And so that's the way I always left it. Fast forward some time, and now at this point, I'm married and looking at buying a house. And I'm talking to my financial advisor about it. And I was saying, with the down payment costs and the mortgage and the extra bills that we're going to have to pay, we still have cars that we need. We'd like to take some vacations. All this stuff adding up, I'm really not sure how we make it work. And at the time, what I was expecting was that the financial manager was going to come back and say, "Oh, okay, well, let's look at maybe you look at a mortgage that's extended out a little bit, or maybe we could cut back on some of your investments for a little while to help you save some of that up, or maybe you take some staycations instead of going away." And instead of any of that, the guy came back, he just looked at me and he said, "You pretty much have to win the lottery to make this work." And that kind of blew my mind at the time because this was a guy who was supposed to be helping me plan for my future. And with that response, immediately something clicked for me. And I said, you know what? I need to start taking more responsibility for my financial future. And so that got me into investigating the stock market and trading and stuff. And I started off originally just sort of investing in stocks, and the money that I was giving to them, I was slowly starting to take more control of it myself. But I was also doing a lot of research trying to figure out, like everybody else, you're out there trying to learn how to trade. And the goal initially, like I said, was saving for retirement. And as I progressed through it, started to get into technical analysis. And the problem was, one indicator would say this means this, another indicator would say that means that. A lot of this stuff didn't align. And what I learned after years of research was, I mean, the first thing is everybody's out there looking for that magic indicator, the one that tells you exactly when to get in at the bottom, exactly when to get out at the top. It never loses and you never have to worry about it. And I think a lot of people fail when they try to do this because they're always searching for that indicator and not really learning about what it is that you actually want to see in your charts. Um, and so I started this idea. Well, two things. One was I started to look at the concept of multi-time frame trading, which I'll talk about in a second. But the second one was that instead of trying to find an indicator that did everything, what I started looking at was what are the things that I actually want? What's the information that I want from these charts that will help me um, make decisions about how I want to trade? And what are the tools that I need to measure each of those things? And so, um, what I came down to was there are about six things that I'm looking for. Uh, and they're sort of in pairs, and they're in pairs for a reason. So I'm looking for trend, I'm looking for momentum, I'm looking at waves within the market and cycles, which are similar but have differences that are important. And then the last two are volatility and volume. And so it was a quest to figure out uh, how to measure each one of those and how to put all of that together to ultimately build a strategy for me that helped me figure out what was happening, or not necessarily that we know what is happening, but what are the highest probability moves that the market's going to make, whether you're looking at it intraday or long term. Um, what does that look at? What are the entries that are going to be the highest probability versus the more risky ones to help me figure out when is a good time to get into something and when is a bad time. And so the other really important thing that really clicked for me was this concept of multi-time frame trading. Um, now I I almost don't even want to mention this because, so everything that I'm talking about, I actually teach courses around some of this stuff, but I didn't even want to mention that because this is not some sort of sales pitch and I'm not looking for students. And the only reason I even bring it up is because the huge explanation of the entire strategy and everything takes multiple hours to go through. And so what we're going to be talking about is just a more condensed version, more like the sample platter of everything. So if there are, if I'm explaining things that just don't seem to make sense, I'm happy to answer questions about the stuff. That's the last I'll even talk about that. Um, so yeah, this concept of this multi-time frame trading, what that comes from is that there are a lot of people that are trading the stock markets. Oh, that alert was very loud. Sorry. There are a lot of reasons that people are trading the stock markets. You have people that are day trading. You have people that are trying to hold um, shorter term holds overnight, some swings. You've got people that are long term investing, that they're buying it and they're going to hold it for decades. And all these people are in the markets with different strategies in mind, different goals they're trying to achieve. They have different risk tolerances for what they're doing, different experience levels, different amount of times that they could be looking at the charts. And so all of this is happening at all these different levels. And if you're only looking at what the stock market or what the charts are doing on one particular time frame, you're kind of missing out on a lot of the bigger picture. And so if you think about all these guys trading, well, I'll you know what, so coming from a science background, originally the way I looked at it was the concept of waves, whether you're looking at sound waves or light waves. And if you're familiar at all with it, um, the concept of superpositioning of harmonic waves. So the idea that there are periods within these waves where they're both cycling to the upside, period, like at the same time, or periods when they're cycling to the downside. This superpositioning means that those waves work together to push in a direction. It gives you more amplitude and stuff. An easier way of looking at it, it's a more simplified version, is the concept of a car. So I'll just push this over here and we'll do this. Sorry if I've completely dazzled you with my MS Paint skills here, but I threw this together this morning really quickly. So basically what you've got here is a car and you've got three people, a big guy, a medium guy, and a little guy, and they're all pushing that car. Now, I think we can all agree that if somebody's pushing that car, if they're all pushing that car together, the car is going to go at a pretty decent speed. It's going to travel further. You've got three people doing it, so that's going to work out pretty well. Versus, oh, sorry, that's not the way I wanted to do that. So if one of those guys steps around to the front of the car, now he's pushing back against it. Now, these two are probably still going to be able to push that car forward. It'll be slower. It won't go as far because this guy's pushing against it. But we can kind of expect that that's the way that will work. And then sorry, I'm just getting one more image here. And then if we get something like this, where we've got this medium guy and this little guy pushing this way, we've got this big guy pushing from the back, we're not really sure what's going to happen here. It might be that they're strong enough to overpower him and push him backwards. This big guy might be strong enough to push against both of those. But we could expect that it's probably not going to go very fast or very far in either direction. And so that's essentially what I'm looking at. If you look at these people and you think about these as different time frames within the market, whether you're looking at 2-minute candles or 15-minute candles or daily candles or weekly candles, if you make that association that Generally, on your bigger time frame candles, like a daily or a weekly, they're stronger. They've got more of an effect on the direction that the price in the market is going to move. Where your smaller time frames can have a shorter term effect on the overall price movement. So, what I mean by that is, right now we're looking here at the 2 minute candles. We've gone through several waves and cycles in some different directions. And right now it's moving to the upside. But if I look at something like, I might have to go a little further up. Um, or if we look at let's just look at the daily candles. If we look at the overall trend, obviously we're still trending to the downside. So those smaller time frames can still have shorter term effect, but it's the overall bigger picture ones that are going to they're going to have a longer term, bigger effect on price movement. So that's why, even though we have been trending to the downside, there's been opportunities where people have made money playing stocks up or buying calls in options. Um, so, so the important part about the diagrams that I was looking at is that it would make sense that the best time to be taking trades is when you have the alignment of all of these time frames all pushing in the same direction. So if everybody's standing at the back of the car, then you're going to be more successful. And so that's what I'm really looking at when I watch how things are trading. So again, as an example, if I look at the 15-minute time frame, we have been in this, you can see there's been a trend to the downside. It started to come back up. We made this higher high compared to this high, and it's pushing to the upside. So since, excuse me, it looks like about 7:45 this morning, if we look at a smaller time frame like the 5 minute, and you were looking at only taking trades that were moving in that same direction, we've got obviously this big one here, this little one here. It looks like we made a higher low and we're continuing to the upside. And so overall, we're generally having more success playing to the upside while we're playing with that bigger trend, versus if we were trying to take it down every time there was opportunities to take bearish trades here. And so that's the concept of the multi-time frame trading. But that just talks about the alignment, and what we've got to talk about is what it is that we're aligning. So the key things that I'm looking for, like I said, the first two are trend and momentum. Now, I've been doing this long enough that I can see within the different waves at the different time frames we're using. I can kind of see the trend. But if you weren't super familiar with it, you could use something very simple like a moving average. A moving average is probably, when you're looking at trend, it's probably the most basic, but still one of the best tools that you can use for measuring trend. Um, and at least when people look at the daily chart, I know I'm on a 5 minute chart right now, but people looking at least on the daily chart, the most common trend average that people tend to use is a 50-period moving average. Um, I'll just move out to the daily chart very quickly, and you can see that if you look at this line, obviously the price moves, so the moving average lags behind the price some, but in general, you could see that that line sort of demonstrates the trend of the direction. Even though we have periods like this where we had a sharp drop, then it came back up, another sharp drop here, but overall, it's telling us the trends continue to the upside. Lately, starting around end of February, maybe mid-February, we've seen that start to curl back down, and we're showing that the trend is to the downside, which it has been on SPY for quite some time, and well, a lot of other stocks as well. And the important part about trend is probably visible in the chart is that, and we've all heard the saying, the trend is your friend. You're going to have better success in trading with that trend. And so that's the first thing that I'm looking for. The second thing that I'm usually looking for is momentum. Where the trend is telling you the direction that things are moving, your momentum is generally telling you how how strongly it's moving in that direction. There are several indicators that people generally say are momentum indicators. They'll talk about stochastics or RSI or MACD. I like MACD. I believe that one is truly a momentum indicator. I don't believe in stochastics or RSI as a momentum indicator. I know they're called that, but the reason why I don't like those two, and I've got nothing against the indicators themselves, but specifically to call them a momentum indicator, the problem is they're what we call a bounded indicator. So RSI mathematically has a range from 0 to 100. It cannot break out of that range. And so the problem with it as a momentum indicator is in a period of very high momentum in a particular direction, say the price is coming up very strongly. Once it hits 100, if all of a sudden there's a huge burst and the price drives up very, very quickly, the RSI is already pegged at 100. It can't go any higher, and it can't tell you about the change of momentum that just happened. Now, this isn't a regular event. It's actually a little bit rare, but still, I've always felt that at those times when that happens, that's enough for me to say that's not the indicator that I want to use. Again, nothing against RSI or stochastics or any of those, strictly because they are a bounded versus an unbounded indicator. That's the only reason I don't like using those for momentum. And so I generally use MACD for momentum. Now, this MACD that I just pulled up, there's nothing special about it other than I've taken the slope direction. Well, okay, there's a couple of things I changed in it, but it's using the default. If you just pulled up like a default MACD, you would still see the same stuff I'm looking for. Just wouldn't be colored the way I've got them. So what I did was, first of all, the histogram that's in MACD, I don't generally need it. It's not something that I refer to, so I just got rid of it. But because the MACD and the signal line they're both lines, and because I wanted to color them based on the slope direction for those lines, it got confusing if there were just two lines that both switched between red and green. So I just made the MACD a histogram. So the histogram that you see is the MACD, and like I said, when it's sloping up, it's green. When it's sloping down, it's red. It just helps me determine the direction of the direction that it's moving. And then I also have that for the signal line, which I don't generally use for entries and exits, but I do like the signal line as confirmation of momentum and direction. And so when the price crosses the signal line, that's where these vertical lines come in. Again, it's not something that you need to have. It's things that I look for, and so I've all the indicators that I use are custom, and so they're giving me little bits of extra information that I'm personally looking for. You don't need to use the custom indicators that I've created to do this strategy. It helps me. That's all. So yeah, the idea is that obviously when the MACD is making a bigger move to the downside, then you've got stronger bearish momentum. When it's making moves to the upside, it's got bullish momentum. And when it crosses over the zero line, those are much bigger signs of momentum in that particular direction. And so I'm watching those to see how strongly this is moving, or areas like this when it's kind of flat, where maybe along with other indications, if it's kind of flat in that space, then maybe I don't want to be playing with it at all. Maybe I want to step away from it. And so having that momentum helps me understand what's the strength of the movement that we're currently seeing. Because the other thing about that is the stronger the movement, the longer it's going to last. Just trying to think if there's anything else I wanted to say about that. Yeah, so for now we'll leave it there. Let me just get rid of this line real quick, and I'm going to take off this moving average because I don't actually need it. I just want to clean things up. So the next two things we need to talk about are waves and cycles. Now, waves and cycles are very close to each other. They're almost the same thing. So every wave has a cycle, but not every cycle has a wave. Let me explain what I mean. So first of all, when I'm talking about waves, I'm talking about just the general movement up and down of the price. We have a wave down right here, a wave up. A wave is just the movement in one direction. I know as a kid when we're drawing these on paper, you draw the wave as up and down. We're just talking about the direction in one way, not both. The second part about that is um, when I talk about waves, I'm not talking about Elliott waves. Elliott waves are something much more complicated. You could do entire courses on just learning Elliott waves, so that's not what I mean. We're just talking about general price movement. And so here we've got what your structure normally looks like is or the ideal structure would be something like you get a wave up, you get a pullback, you get another wave up, you get a pullback, and you continue as long as your trend lasts. I generally use like a 5-wave pattern just to give the example, but within a trend, you don't need to have exactly 5 waves. It could be 3, it could be 7. We've seen them sometimes go on for like, 15, 18, really big numbers sometimes. But in general, the longer your trend lasts, the um, the less return that you get for each one of your moves. So towards the end of your trend, generally your waves start to get smaller. Uh, I actually used the wrong indicator. I'm just going to do this really quick. Just draw this out again. So just to give a little bit of definition when we're talking about that. So this would be wave one. It's your first impulse wave within the new trend. And the reality is we probably don't know that this is the first wave in our trend. Like let me stick it on here and pretend this is the movement. So we had all this bearish movement to the downside, and now we've got a wave coming up. This could very much like this wave here, this could just be a retracement before we take the next wave. So this being the first wave in a new trend, we don't actually know that that's what it is at the time. So we get wave one coming up. There's no other than it is a wave in the direction you want. There's no other real definition that we can give for this wave. Then we get wave two, and the only thing we can say to define wave two is that when it pulls back, that it does not go below the start of wave one. If it did, then that would just be the next wave continuing the bearish trend that we had before. We go on to wave three, where the expectation is that wave three will go higher than the peak of wave one, and then you just continue. Wave four pulls back. Wave four can go below the high of wave one, but it shouldn't go below the start of wave two because then again, you're starting your trend in the other direction. And then you've got wave five coming up, and then that continues. Now, this is ideal. Sometimes you might get a scenario where for some reason the wave does get, maybe it just does get slightly below that previous. It can happen. All we're talking about is the ideal scenario for these waves. And if I did get a pullback, like let's look at the example of we're moving this way. We get wave three to the upside, and now we're pulling back, and I'm anticipating that we're going to get a wave five so I can play that one next. Obviously, if this comes down and it starts breaking below this previous low, I'm going to get very skeptical about its ability to continue to the upside. Depending on what all the other stuff I'm looking at looks like, I may just decide to abandon the idea of playing this to the upside again. It all depends on the big picture view. Um, but this is essentially what I'm looking for waves. And the idea is that once you've got a trend built up, I want to take all the waves that are going in the direction of the trend. Wave three and wave five are usually my favorite waves to play. They usually have the highest probability of success. And so that's what I'm looking for. The other part we talked about is cycles. And cycles, like I said, they'll look just like waves. As a matter of fact, if I go over here, because the nice thing and the other reason why I like to use MACD is I can also use the MACD as my cycle indicator, telling me when a new cycle is starting. And that's really why I have this color change happening. So we've got this bullish cycle happening over here. We could see that we start to come down a little bit with this red candle, and then we get this red candle, we come down. And this is the first time that the slope direction of this MACD switches from up to down. Now, I know there are a lot of people that use different entry points as what they consider the change in direction for MACD. Specifically, I use the slope direction, which is probably a lot different than a lot of other people. But at the same time, there are other things we're going to be looking at that give this a lot of strength. So it's not just looking at this one time frame on its own. We'll talk about that in a bit. But let's say this point right here. So this candle ends, and I've got this telling me that there's a cycle start. And that's generally where I'm now looking at. I've got the start of a cycle. If all the other stuff I'm also looking at matches up, then I'm saying, okay, I'm now looking for an opportunity to take this further down. And you can see that we go through this whole big cycle to the downside, and it started coming back up here. And this is the first candle where this actually changes, and we get into a bullish cycle coming this way, and then we revert back into a bearish one. We did get we did get this little piece right here, which at the time that it happens, I would consider this two extra cycles in here. But that's getting a little bit complicated, so we'll leave that off for now. But you can see what I mean about cycles moving with the waves. The reason why cycles are different than waves is there are periods of time where you may have price movement coming up, and we get into what appears to be a cycle, and then all of a sudden, price kind of stops and it just kind of moves sideways. One of the areas that we see this is when we talk about bull flags and bear flags. So you get a period where you get that sideways motion, and you really don't know what to do with it at that point until eventually it's going to break out and keep moving. In this space, even though we're not getting waves, there will generally be some sort of cycle involved with it. Just going back here very quickly to see if, oh, I'm on the daily chart. That's not going to work. Let me go down to a 2-minute candle. We'll find some. So this is an example here. We've got this space where we're really kind of moving sideways. It's hard to call these waves, but we've got this motion where this is considered a bullish cycle. Got a bearish cycle into a bullish cycle. So even though we're getting those, we don't really know what's going on because it's moving sideways, but it gives us a little bit of an indication of what's happening with those cycles and what we can be watching for when the next one starts. But like I said, even though we've got those cycles, we know what we're looking for, but because we've got things like very low momentum, then we're not even taking trades in this. Now, this is after hours, so you wouldn't be trading this anyway. But I use this as an example because sometimes we get patterns like this during the day. And that's why we're looking for, we're measuring cycles separately from what we're seeing in the waves that we're looking for. So the last two things we're also looking for, because think about this, we've started to understand the trend and the direction that we're looking for. We're looking at areas where we're seeing that we've got enough momentum that it makes sense that we could be taking trades in this space. We've got our cycles and our waves where we're understanding where those start to help us get some entries. But we also need to have some estimation on how far this is going to go. So we need to understand what the volatility looks like and how far it can move. And with that, we also want to understand the volume that comes with that. So we'll talk about volume first because that one's really easy. Most people generally look at volume, and I don't need a lot about volume. There's only a couple of ways that I'm really using it. I'll go back down to the 2-minute chart again very quickly here. With volume, obviously, we want to be taking trades in an area where we've got a fair amount of volume happening. With volume comes liquidity. With liquidity means that the gap between your bid and your ask are going to be much smaller. It makes it easier to trade. And you certainly don't want to be trading into something with low volume where you're not going to get any movement. And then because there is no liquidity. If you decide you just want to get out of your trade, the ask that you paid becomes much more than the bid that you got when you sold, and you end up taking a loss even though the price didn't really change. Um, so you want to avoid times like that. So we want to watch volume. The other place that we'll look for volume, other than just looking at where volume's at in general, is looking for little hints of areas where we may have a space where we've got a lot more bearish volume, that it's higher. I'm not seeing any initial good examples here, but sometimes you will see spaces where, let's say you've got bearish volume, you've got a bearish trend, price is coming down, but then you start to see the volume reducing within that space. The price starts to come back up a little bit, and then you start to see increases in the volume on that bullish side as it goes back up, telling you that basically the sellers for now have started to drop out and buyers are starting to step in. And so sometimes that can help give you confidence for the trade, again, as long as everything else matches up for what you're looking for in that trade. So volume is pretty simple. And the last thing that I'm looking at is volatility. Now, originally when I was looking at volatility, I used to use Bollinger Bands. I was a big fan of them. I liked the way they worked, but over time, I actually changed to using Keltner channels. And the reason for that is I'll have to put some on the chart very quickly here. So if you're familiar with Bollinger Bands, they basically take a moving average of the price, and then they take a standard deviation calculation of the price. They make an average out of that, and then that gets well, there's a multiplier to it. The standard one is a 2, so you multiply that value by 2. You add that value onto the moving average, which gives you your upper band, and you subtract it from the moving average to get your lower band. And what that does, because it's based around standard deviation, when there is low volatility, then the bands contract. They come much closer to the middle line. And when there's a lot of volatility, they expand out. And you'll notice that in general, the price gets contained within those Bollinger Bands because of how that standard deviation is calculated and how it's applied to the movement. When I compare this to Keltner channels, this will be a little bit confusing because of the blue on blue here, but the important thing is that you can see that it's a lot easier for the price to break. Here, let me get rid of the Bollinger Bands for a second. It happens more often that you see the price break out of the Keltner channels. Now, I'm actually not seeing a lot of examples of it. We are over here. But we see that happen more often with Keltner channels and with Bollinger Bands. And the reason why I switched to those is because a lot of times once you break out of those Keltner channels, the zones, or in this case, the channel bands at the bottom and the top, they can be, originally we start looking at them as areas of resistance. Well, let me get one little piece of terminology out of the way. Generally, when I talk about support, I'm talking about price coming down and hitting something where it bounces. Generally, when I'm talking resistance, I'm talking about something that is above the price that it runs into and can't get through. Sometimes people use those interchangeably, but just for the sake of this conversation, I just want to point that out, just so when I say support, I'm always talking about underneath. And when I say resistance, I'm always talking about something above. And the reason that's important is because what I'm looking for is places where initially I'm looking at this upper band as resistance in this case, looking to see if it will reject and come further down. However, if the price breaks above that zone, when it comes back down and retests it, at that point, I will look for it as support, because we do get instances, and I'll show you examples once we get a little bit more into this, where exactly that happens. And so it becomes these zones where the top of the Keltner channels or the bottom of the Keltner channels are, I'm always looking at those as either support or resistance. And if it breaks through, I'm looking to see if it will retest and switch, because that just adds more confidence in the trend direction that we're moving. So we've got these 6 pieces. We've talked a little bit about how we're using them, but now we need to tie all this into the multi-time frame stuff that I was talking about. So I'm going to, again, introduce some custom indicators. They're pretty much the same thing. They're built for a little more on how I want to see them. You guys have seen some of them as I've pushed them out previously. But you can do, at least on TradingView, you can still do what I'm going to do, which is to show you the multi-time frame version of some of these indicators. So, for example, right now we are on the, well, I'm going to switch to the 5-minute time frame. We're on the 5-minute time frame. If I use the 5-minute Keltner channels, this is what they would look like. Now, I have custom created these ones where there's a band at the top and the bottom. I've always preferred to use a band because the value to say that you're running into the resistance of that upper band, it's not an absolute number. And so I like to have these bands just to keep it as an area where, yeah, we didn't stop exactly at that band, but we didn't stop exactly at that line. We got under it, but we hit this band and we bounced off of it. So I'm looking for that sort of thing. The same way on this side, we got out of it a little bit. We came back. We sort of bounced off it. We did get a little bit under it for a second, but we bounced off for continuation to the upside. And so when I look at these, I don't really see this as 2 separate lines. I think of it as if I took a big thick marker and drew this top band with a big thick marker, it's all the same line to me. So as long as whether I bounced right at the start of it or in the middle of it, sometimes even if it gets just a little bit below it, I still consider that a bounce off those lines. But like I said, this is the 5-minute version of it. This is the 15-minute version. So basically what this means is, oh, why am I not? Oh, there we go. I'm just going to hide these other ones. Basically what that means is if you went to the 15-minute time frame and put on the 15-minute Keltner channels, this would be where they were. Just that you'd have 15-minute candles instead of 5-minute candles. And so within this range, this is now specifically I'm talking intraday scalping in this particular case, but what I'm talking about applies to any time frame of trading that you're doing. So when I'm doing swing trades, I generally use higher time frames where I will look at the 4-hour Keltner channels, the daily Keltner channels, the weekly Keltner channels. I'll start working on bigger time frames. Exact same strategy, just I modify the time frames for the range that I'm playing in. When I talk about long-term, really long-term investments, retirement account kind of stuff, in those cases, then I'm even moving out to monthlies and looking at it that way. I'll even look at, when I talk cycles, I'll look at what the quarterly cycles are for stuff, for really, really long range things. So looking at this area, as this price is coming down, we've got a trend to the downside, right? We got up here, we hit this, we rejected, we started coming down. If we were taking this trade, if this was moving to the upside, and we're looking for, we're moving like we've got bullish waves and bullish cycles happening here. We hit this resistance, and we reject off it. So this is one of those instances when I reject off of a particular trend, when I reject off a particular area of resistance, I'm looking at that as a potential spot where we're going to stop, and we could actually change direction now. So this is one of the areas where, and I'm looking at this in hindsight, where we had some bullish movement. And now this is actually wave one in a new trend to the downside. Wave one down to here. We get this pullback up. It's wave two because we did not get above the high of the start of wave one. And we get this move down to, really that continued down here somewhere. And then we start coming back up. But forget about this stuff down here. Let's just look at this. So we get this rejection. We've got wave one. Now, I may or may not take a trade on wave one. When it's something like this, where it's a rejection off of some strong resistance, I might take that trade. But remember, I said 3 and 5 are generally my favorites. And so if I didn't take this trade, I'm definitely going to take this one. And again, this is all, I'm just showing you an example of this stuff. This is pre-market, so I obviously did get an opportunity. There were no options being sold at this point, so it's not like I actually got into something here. But it is the start of wave 3, which means we've got a new trend, at least on this smaller time frame stuff, right? So generally what I would look at is say, where is the start of my actual cycle? Which it's a little bit hard to see. Let me zoom in a bit. We do have the change from green to red, just the signal line's kind of hiding it a little bit. But this was where that happened. And I wait until this candle closed. And this is the first time that I get that start. And so what I would do is on the next candle, when this candle crosses this line, which I call my trigger line, once we get across under that, I'm taking that trade. And for now, my initial target is probably going to be this bottom zone right here. If we can get down to there and hit that, then if it hits it with a lot of momentum and it keeps pushing and it ends up dropping through it, then I'll just hold on and keep and stay in that trade. If it starts to bounce, or the other thing I generally set, and this is getting a little bit deep into the weeds here, but I generally set trailing stops. Always mental. I don't set them manually, or I don't set them automatically. But mentally, I will have a trailing stop where certain percentages of gains, if I pull back so much, I'll take the gains. But in this case, I would have entered here and held through this move. Now, I don't know. Maybe there was at some point where it came down really far and then pulled up really quick, and that did actually stop me out. That is something that might have happened. I would have to look at smaller time frames to really tell you for sure. But for now, let's just take it at face value and say that this just moved right down. And so I would get in this trade. I would have gotten down here someplace. And despite the fact that all my indications are still bearish, either the fact that we rejected this and started coming back up, or just the fact that we got this far down and retraced back up. This was we were down at 487.40 and we got back up to 480. That was a $2 pullback. So there's a very, very high chance that somewhere within that $2 pullback, my trailing stop hit. So I would have been out, down here someplace. Once I get that, all I'm doing is I'm looking for, we've got this trend established. And so all I'd be doing from here is I'm looking for the start of the next cycle, the next move. In this particular case, because this was wave 3, remember, I always want to play with the trend. And so this move would have come down, and I would have been looking for the start of a bullish wave, a bullish cycle, which this is going to complicate things a little bit as well. And that's what I'm trying not to get too complicated with it, but we get the start of a cycle here, but we immediately move back down and got back into it. So when I get these one-offs, I'll generally consider that cycle canceled. And so it restarts over here. I consider this more the start of it. We get a cycle up, but I'm also not necessarily interested in taking this trade to the upside. There's a lot of stuff that I'm not seeing here right now, but looking at it from this point of view, remember, I'm still looking to continue with the trend. So I'd be looking for a pullback, and I'm actually looking for the start of the next bearish cycle so I could continue to the downside. Now, in this case, that didn't happen. But I'm not too worried about that. What I wanted to do is give you a demonstration of essentially how I'm taking those trades. But it gets a little bit more complicated than just this. Um, because we've got to talk a little bit more about the multi-time frame part of that trading. Remember I talked about how we want to be trading when they're all moving, not necessarily trending, but they're all at least cycling in the same direction, meaning that they're all in waves going the same way, or they're very close to it. And so generally what I would be looking at, let me put this in replay mode so we can actually look at it at the time. So I'm going to go back to here, and I've got to play through a couple of places here. I went one too many. Let me try that one more time. Oh yeah, okay. So this was the one where we started. But right now I'm only looking at the 5-minute time frame. Remember, I'm generally looking at multiple time frames. And so in this case, what I would also be doing is looking at the 15-minute time frame. Because if we're in a bearish trend, then I would expect that that 15-minute time frame that I'm also using would be agreeing with that. And I can tell you right now, it's not quite there. But our MACD is very, very flat. It was moving to the upside. It did actually attempt at one point right here to start that bearish cycle, but it kind of backed away from it. And it's very, very close to it now because this is kind of flat. I also look, realistically, I'm generally looking at about 3 time frames. Personally, the other one I'm usually actually looking at is a 2-minute time frame. I'll explain that a little bit more in just a second. But you can see that in reality, the 2-minute and the 5-minute both started their bearish cycles at the same time. If we go back to that car analogy, that means that essentially we had 2 guys who were fully rested who just started pushing at the same time. So that's what we want, is we want all those cycles changing direction as close to each other as possible. It means that they've all got stamina for as long as possible. We don't want to get in, if we have a 2-minute cycle that started and it's now been running for 10 minutes, and only then do you get the 5-minute cycle starting, chances are that 2-minute cycle is getting kind of exhausted. And so it's probably going to, at the very least, need to pull back and then start the next cycle to the downside before it's really ready to go again. So it's that timing around it. So I'll look at multiple time frames to determine where that's going to happen. So you can do this by switching between your time frames. And even if you weren't using MACD as your cycle, say you do like RSI, or you do like stochastics as a cycle indicator, not a momentum indicator, but on the cycle side of it, you could use those the same way, where you would look at different time frames and see, are they all moving the same direction? Do they look like they're close to being in the same direction? You can do it that way. Now I did create my own indicator that I call cycle point. And what cycle point does is, let me back up for a second. So the one thing about using MACD is you're a little bit reactive. You're kind of watching it, you're waiting it. We do know that we're flattening out here, so that change could be coming soon, but we don't know exactly when. And so we're relying on looking at things like this candle's flat, or momentum has been slowing down, or whatever, to make that decision. Cycle point is, all it does is it goes through and it does the math to say, for that cycle to start, based on where the current price is, the price would have to get to this level to get that cycle to start. And then what it does is it gives me that cycle point for all the time frames that I'm looking at. So let me go back to the 2-minute chart here. And again, you don't need this indicator to do what I'm doing. It just makes it a lot easier for me. So this is cycle point, and I'm going to get one thing in here because there's a cloud in here that I use for something else. I'm just going to get rid of that just so it's not so confusing. I'm also going to get rid of our Keltner channels just because the lines in there, we're starting to get a little cluttered. So I'm just cleaning this up. So you see there are 3 lines. This teal line here, this is the 2-minute cycle point. The red one's the 5-minute cycle point, and the purple one is the 15-minute cycle point. And you'll notice back here, they're nowhere near each other. Now we get into this space and they're starting to clump together. And if I look specifically at the time on this 2-minute, we know that in this candle, way back here, up around 496.12, this 2-minute candle crossed over the 2-minute cycle point. So we're in a 2-minute bearish cycle. And you can see that by the confirmation that we've got that MACD slope into the downside. At the same time, I can also see that we crossed over the 5-minute cycle point, which is right under it right here. And I know that this particular candle, this candle ends at 7 a.m. And so I know that 5-minute candle also ended at the same time. I know they're both right there. And more importantly, I know that we're actually pretty close to that 15-minute cycle point. So even though we haven't started a 15-minute cycle, we're in a good area for that to potentially start. And in fact, we saw that earlier it had tried to get under it, came back over it, made a lower high compared to the previous cycle high up here. And this is looking like a good spot. We've got lots of, if you think about all the things we talked about, momentum, trend, waves, cycles, volume, volatility, when we look at all of those, think of them as like points. So if all of those different indications are looking favorable, we've got a lot of points in our favor, which just increases our probability of having a successful trade. We don't know it's going to be a successful trade. All we can do is find the best case setups and kind of hedge our bet as best we can. And so in this case, I know that we're very, very close to hitting that. So I can feel a little more confident in taking this particular trade versus well, even going back to this one, that one actually did move a little bit higher. It's not a great example. We also get a lot of separation in space in pre-market and after hours. If you get any amount of volume whatsoever, you get things like spikes like this. So, but my point is that generally, when things are not when they're not aligned very well, then we're not expecting that we're going to get those cycles for very long. So we had this little bearish cycle right here. It popped back up. We got this movement down here, didn't go very far, came back up. It actually ended up going higher. And so when we don't have all those aligning, then our chances aren't as good. And it's a lot of times a better chance that it's going to move against us versus back here. This was yesterday, where you could see that we had all these movements down. And through all this, we are below that 15-minute cycle point, meaning that we're in a 15-minute bearish cycle. So what I would be looking for is every time we get a setup for a bearish cycle, I want to take it. And I'm going to ignore the bullish ones because I'd sort of be moving against that. I'd be moving against the trend I'm in as well. And I will continue doing that until I start to see signs. Let me put these 15-minute channels back in here. I'll continue doing this until I start to see signs of trend reversal. And so there are basically 4 signs that I'm looking for. Actually, I'm going to show you one other indicator. All this indicator is doing is it helps me count waves. So once it determines that we're in a bearish trend, it counts the waves for the bearish trend. When it sees that we're getting into a bullish trend, it just counts those. So as an example, it only goes back so far, so you're not seeing the first few, but you could see we had, this would have been wave 5 coming down to a lower low. 6 came up, Now we've got wave 7 starting to the downside, lower low, up to wave 9. Wave 9 came down to a lower low. Here we get a higher high. We know that that broke our trend. So it puts this as a higher high, and it sort of resets the count at that point. Actually, because it came back down and this was a higher low compared to this low, it thinks we might be starting a bullish trend, and so it gets into that. It labels it as wave 3 in a bullish trend. It actually didn't make it to a higher high. This puts us into a complex wave set. I'm not going to explain that because, like I said, I don't want to take up too much time, but the point is this indicator helps count those waves. And I just wanted to bring that up so that I just completely, this was supposed to help me show you something else. Give me 1 second. I just forgot what the other thing was. Right, the signs of trend reversal. That's what we're looking for. So this is kind of helping me with that. So what I'm looking for with signs of trend reversal are 4 things. One of them would be a higher low, like this. So that would be my first sign of a potential trend reversal. So we've got one right here. Same thing right here. We had one right here. The second one that I will look for is a break in the trend with a higher high. Now, I'm doing this talking about going from a bearish trend into a bullish trend. So the fact that this came up and made a higher high instead of a lower high is my first signal of potential trend direction change. We got down here to a higher low. We've had a higher high. We've got a higher low. So I've got 2 of those signals. The next one that I would be looking for, and I generally need at least 3 out of the 4 before I'm really willing to start playing the other trend. The next one would be, in this particular case with my intraday stuff, I've got my 15-minute cycle point is right here. I would need to see a 15-minute candle close above that line, meaning that I need confirmation of a 15-minute bullish cycle starting before I'm willing to give up on this 2-minute trend to the downside. Now, even though I don't have 3 or 4 of those signals right now, the fact that I have 2 might also be enough for me to say, you know what, at this point, I'm going to step away and just let it sort itself out because I don't really know what's going on. I've got half my stuff saying that it is ready to come up, got half my stuff saying that it's not. And so I might just step away from the whole thing. Now, in this case, the setups are very good still to the downside, so I would have continued. But this whole way, we don't really, and then the fourth one is we've got our 15-minute Keltner channels here. If the price gets back inside those channels, that would be my 4th signal. Now, let me see if I've got an example of, like coming back to over here, we were bouncing off the top of the Keltner channels, which happens more often than you'd expect. Now we're up here, we get down, we get below that 15-minute cycle point. We know that somewhere within here, so right around here was 10:45. So I know a 15-minute candle started at 10:45 and previous candle closed under that. So I know we've got a bearish cycle on the 15-minute. We get down here and we are back inside those 15-minute Keltner channels. So that's 2. We got below this previous low by the time we get down into this area. So we've got those signals, and we don't actually get a lower high until over here, but we did have about 3 of the things we were looking for over here. Now, of course, having all that stuff doesn't mean that everything is going to line up perfectly and you're always going to be set up. Like I said, we're only looking for things that are going to give us the highest probability of getting in. It does not guarantee success. So we still got to be careful about things. There's, like I said, there's a lot more that I end up talking about entries, stops, all those things. But essentially, this is how I'm trading. And over the past couple of weeks when I've got time, I've just gone in and started posting charts of what I've done to kind of familiarize people with it. So I think enough people saw success in what I do that I think it was worth people wanting to hear a little bit about it. Um, but that's basically what I wanted to explain. But I'm definitely, if you guys have questions about any of this stuff, I'm happy to answer any questions you've got.
I have one quick question. What's your multiplier on your ATR for your Keltner channels?
Um, it's been so long, I've got to check it. It's not standard. I think I use a 10. Let me double check it. No, I am actually
Usually,
using 20.
okay. Oh, that's the length. Yeah, but your inside multiplier is 1.5. Yeah, and
Oh,
that's what
sorry,
you
you.
put.
Sorry, I thought you meant the eight. So there is a separate for the average calculation. There's a separate. That's what I thought you were talking about, and that's why I was saying 20. Yeah, for the two zones that I use 1.5 and 2.0.
Okay.
1.5 for the two
Sounds good.
inside, 2.0 for the
Hmm.
outside. So you could, if you wanted to, you could add Keltner channels twice to your chart and set one of them to 1.5, set the other to 2.0, and you would get.
Right.
There are some other slight differences in my indicator, but it'll be very close.
Okay. That's great. That was is it if anybody else has questions, but I just wanted to comment. That was an awesome presentation. Very, very interesting.
Well, thank you.
It's amazing. It's amazing what you've put together. It really is.
Well, I mean, a lot of what I do comes from. I mean, the part of the reason I teach stuff is because uh, I learn a lot from going through that process. When I get questions from other people about stuff, it a lot of times sees what I'm doing from an angle that I didn't really think about. And then it also helps me find other things that I want to research. Um,
Right.
because
Right.
I'm always researching, I'm always developing, I'm always making changes to stuff. In this, I mean, that's the thing about the markets is there's no one thing that you can learn to do, and like there are a lot of strategies. There are a lot of successful strategies. What I'm doing is not the only way that people make money. There are a lot of successful people here that I've seen that have completely different ways of reviewing the market compared to what I do. Um, the one thing I will say about it is that to find long-term success, you can't take someone else's strategy and change your life to meet that strategy. These people have different um, they have different risk tolerances for the trades that they're taking. They have different reasons from experience levels on why they might do things. Different people control their emotions in different ways. They have different goals, all kinds of reasons. So I always tell people you need to take a strategy and you need to modify it to fit your life. Excuse me. Um, so, if people are looking at doing something like this, I always encourage people to say, if this, you got to experiment with stuff and um, find what is working for you within someone's strategy, and then adjust the things that are not working for you into an area that it does. Like as an example, um, years ago when I was doing this, I've always been looking for online groups just to have conversations with people because when I started doing this full time about geez, what year is it? Yeah, it's been about 9 years that I've just been trading for a living. Um, but what I realized very quickly was that if I was just going to sit in a room by myself without anybody to talk to and no communication, I was just going to quit and go back to a day job. So,
Oh yeah. It's a lonely
I've
profession.
and having a lot of people to talk to about stuff always keeps me learning. But what I ended up doing, there was one group that I joined, and there were some guys in there who were trading some really big amounts. And so at the time, I said, "Hey, you know what? I've got a really successful strategy on what I'm doing. It seems to be working really well for me. Why don't I just turn up the knob? If I risk more money, I'll make more money, and this will be great." And the problem is that when I started following what they were doing as far as trade sizes, it started now I started getting nervous on a pullback that I can normally handle. I would see like, I'm down like $900 on this pullback. It's starting to put me outside of my comfort zone. And what happens is I would have an emotional response. I would make emotional decisions about the trade that I was in, and maybe I would end up taking a loss. Where if I had held it to the extent I would normally hold that trade, it turned around and ended up going in the direction that I wanted. So it's very important in my mind that people always try to adjust that strategy to what works for you, put it inside your own parameters. If there's a strategy that needs you to be staring at the chart all day and you've got a day job, you've either got to find a way to build that out so that you don't have to be watching it all the time, or you've got to find another strategy.
Yeah, I agree totally. That's a very good lesson. Any other questions? I kind of jumped in there. Somebody else may
Not
have
a problem.
question. Okay, well, that was, like I say, that was an awesome presentation. It's been recorded, so it'll be posted in the resources channel, and then eventually I'll post it in Metalgore's Vault, that new channel that we'll use for all of our voice channel recordings. Okay, everybody, have a good afternoon trading, and thanks very much, Trace.
It was my pleasure.